Hello, Winning Investor Nation, and good morning, Ian. How are you today?
I'm doing well. Happy Monday, Amber. Nice to see you.
Nice to see you too. Happy Monday, Ian. Well, I'm going to start out with something a little spicy in this week's video, so please bear with me. In our previous Monday Market Insights video, Ian, we received this comment suggestion from Ahmad, and Ahmad wrote the following. He said, "Mate, we are in a bear season. Tell us something that will save our bleeps and we can all invest in." End quote. And Ian, the way I'm reading this question, Ahmad is right. We are in a bear market season with the Federal Reserve expected to ratchet interest rates higher by at least 75 basis points on Wednesday. We are in recession territory and will likely be dealing with the problem of inflation for a while yet. But I was actually checking Bloomberg this morning, and Bloomberg is always a really good wealth of information. And the updated summary of economic projections to be released at the FOMC meeting this week will be, quote, the first time policymakers supply forecasts out to 2025 will be presented. And Bloomberg data actually expects this number will show inflation returning back to the Fed's 2% target by 2025, end quote. Isn't that interesting? 2025. So what brought to my mind is, what does this mean for us in the interim? Well, to harken back to Ahmad's suggestion, tell us something that will save our bleeps and we can invest all in. We have an answer. And Winning Investor Nation, you as subscribers to Ian's Strategic Fortunes monthly research service, you get his investment recommendations for today and for making money in the future for this type of market. Please click the bull icon right here over my shoulder for those stock recommendation details. And if you had an opportunity to watch my September 15th Megatrend Thursday video right here on this YouTube channel titled 3 Stocks for the Automation Boom. Those are my type of free recommendations. And in that video, I shared 3 key themes that will likely grow in this type of economic environment. And they are automation, robotics, and artificial intelligence, AI. Because as companies face challenging market conditions like inflation, supply chain disruption, increased inventories, and of course, labor shortages, it's most important that they actually invest in technologies that help operational efficiencies, help them be effective and efficient in that realm, and keep their employees as productive as possible. And that's where automation, robotics, and AI come into play. And now is a time for companies to do more with less, just as Ian always says, do more with less. And when companies can't raise prices to make profits, the next thing to do is to cut costs using 2.0 technologies that Ian, I, and the team follow and recommend. And I just have one little pen to put on this. Yardini Research predicts that among the biggest winners in this economic environment, it will be companies that, quote, leverage cost-saving automation to offset higher wages and energy expenses, end quote. So Ian, what do you think about this? What are your thoughts? Do you have any thoughts on that?
I mean, Amber, you pretty much covered everything right there. I would only add that, I think that the biggest picture of the next decade, 2 decades is the reverse of offshoring. So, from trade agreements that were made in the early 90s and the rise of China, you had a lot of production that was offshored to these places where labor was cheap. In the last decade, you've seen labor wages rise in parts of the world where it used to, basically cost nothing to produce, manufacture garments or technical products in China and whatnot. And I think now you're seeing more of the reshoring, more investment in the United States, in domestic countries to build goods that these countries want to use. One of the reasons they're able to do that is with the help of automation.
Yes.
So, the basic economic equation is you are rising or cheapening output by essentially investing in these machines that's making it much more cost effective to run a factory here in the United States. And I would just add, there was an interview last night with President Biden on 60 Minutes. And he was asked about the question of Taiwan, which produces the overwhelming majority of chips in the world, and whether or not that the US would go and defend Taiwan. And he said, yes, we would, which has been a policy of the United States for at least the last couple decades. The markets did not like that because China has been, playing sort of war games with Taiwan right now, where they're flying airplanes near the island and going in sort of disputed territory. And I think more now than ever, that just makes a case for us producing the chips that we need domestically in the United States. There was a CHIPS Act. There's billions of dollars that it's going to go into this industry. And I think if you invest in some of these smaller companies that help these foundries and these semiconductor, fab plants get up to speed, there will be incredible returns for you over the next decade as the US reshores a lot of that, not just production, and everything, but specifically in semiconductors and high tech, because the end market for that is going to continue growing. We're going to need those chips. If you look at the electric vehicle market, those cars need 3 times to 4 times the amount of chips that a regular car needs. So right there, you've got increasing demand. Everything in our households now has some form of chip in it.
Yes.
And semiconductors are going to be all around your environment, whether it be sensors like at the parking lot or, at the electric vehicle charging station, or even to check into a hotel without having like a person at the desk anymore. That's going to require more computational power, more computers, more sensors. And seeing that we're going to have more production in the United States is not only great for our country, but it's also a great investment opportunity for, those companies that are going to help those foundries get up to speed and grow. So, I agree, Amber, with you wholeheartedly about the idea that there's going to need more automation and robotics here in the US, specifically in the manufacturing industry.
Oh, yes, 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 and yes, a resounding yes to everything you just said, Ian. So thank you for your thoughts on that opener. So Ian, on our Slack channel, just everyone knows, Ian and I and the team, we always are communicating constantly in Slack. Another great automation type, robotic AI type app for workers. But Ian, actually, you shared in your a tweet with us on Friday afternoon, and you're saying that we're seeing the highest put call ratio since April 2020, and quote unquote, they will squeeze. That's what the tweet that you retweeted said. So can you share your thoughts on what your thoughts on this particular chart?
Yeah, so we can just pull that up and share it with viewers. So this is basically, an indication that market participants are betting that the market is going to continue lower. And for me, the future direction of the market is determined by news and also how people are positioned, right? You might have experienced this phenomenon where you buy a stock thinking that the earnings are going to be good. The earnings are good and the stock sells off, right? Buy the rumor, sell the news. This is very similar, where it's that people are positioned basically for the market to decline, and any little bit of good news is going to cause a very strong rally in the next week. We talked about this a week ago, where ahead of the CPI, there was a rally in the stock market ahead of the consumer price index. And what I said was that people are banking that the CPI is going to come in weaker than expected, as it did the month prior, right? But we saw it worse than expected, and it caught everybody off guard. So we had a 4% pullback in the NASDAQ. This week, everyone is all beared up. Everybody's got their bear suits on, whether you're a grizzly bear or a black bear. And people are thinking that the market is going to go lower, and that is set in stone. You can see this by the put call ratio. So investors are really positioned for the market to go lower. And usually what the market does is it goes the path of least resistance. So if everybody's betting it's going to go one way, you only need a little bit of positive news, for it to go up when everybody's prepared for it to go down. So that's how I would read that put call ratio. And obviously we can get into some of the news we have this week, because we've got a huge thing happening middle of the week.
Yes, we do. On Wednesday, buckle up, everyone. We'll have the rate decision from the Fed Open Markets Committee on Wednesday. We'll post around 2 p.m. Everyone is expecting about 75 basis point increase to 3.25% on the Fed funds rate. But there are some, like you mentioned, Ian, to the team last week, possibly a 100 basis point reading. What do you see there? What are your?
Yeah, I think there's a 20% chance that the Fed does 100. So whether they do 75 or 100, I think the most important thing is what Powell says afterwards. And what I'm looking for, what I think is really going to tip off another rally, is if he says, we have front loaded our interest rate increases. So that means basically, like we talk about inflation as being some type of disease, some type of cancer that's metastasizing, and the Fed just trying to hit it as heavy as they can, with a dose of therapeutics.
Right.
And if Powell says front loaded, that's going to be an indication that, they might not do 75 in the November meeting. And, we might not get another 100 to 150 basis point increase through the rest of the year. We're starting to see this in a lot of the data. Like we have another piece of information that's coming on Friday in the PMI. And I know you looked at the expectations for that this week.
Yep, it's showing, it's actually, you're referring to Friday, September's preliminary S&P Global U.S. Manufacturing Purchasing Managers Index number. It will post at 9:45, and likely, based on consensus, is showing a softening as well. So that's what we're looking at there.
Right, and below 50 means a recession, right? Yeah. So the Fed has engineered this recession, and if we get to a recession, they're not going to raise interest rates forever. One thing I'll note about last week's CPI that I think was sort of missed by the market is, the headline number was bad, the core number was bad, but if you look at the exact components that are still showing inflation, one of them is what's called owner's equivalent rent, and it's basically rental prices, and there's a lag in terms of rental prices coming off, and the reason for that is when you have a tight housing market, right? When housing prices go to up 20 to 30% year over year, like they have in the last year, people can't afford to buy houses anymore. So that increases demand for the alternative of buying a house, which is renting. So you have people who were priced out of the housing market, priced out of the buying a house market, and that surged demand for the rental market. And it takes some time for the price of rentals to actually start coming down. It lags at something like 6 to 8 months. But I still believe that the 9% print that we saw in July on CPI was the peak. I mean, we might have some more in the 8%, but as long as that's the peak and the Fed's job of raising rates is slowing down CPI, then, what they're doing is effective and will lead to a tradable bottom in this market, right? We saw the same thing with coronavirus, where you had cases that were spiking in March of 2020, and people were selling stocks. They were so worried about it. But then in April, what happened was the daily increase was slowing down. So not the first derivative, but the second derivative. We saw a change in the number of cases was starting to go slowly, and it started to plateau, and then it started to tail off. Similar thing with inflation, where it's, you saw it ramp up to 9%, and now you're starting to see it sort of flatline, plateau, and coming down. A lot of the underlying numbers, such as gasoline prices, have come down. Price of retail has come down. But the one thing that's been sticky is owner's equivalent rent. But if you look at what's going on in the housing market right now,
right,
with housing prices dropping and having so much more supply on the market, you're going to see those prices come down, which is going to filter into the owner's equivalent rent. So you will see inflation come down, and I think that is what the market really needs to see before we end this bear market and start into a new type of bull market.
Excellent point, Ian. I agree. And also, just to point out one other chart that you shared with the team, Ian, is regarding the 2-year yield and how it's nearing 4%. You care to expound on that chart as well this morning? So,
I mean, I thought this was really interesting because if you look at the 2-year yield, which is basically, U.S. government, it's a note that you buy and expires in 2 years. You get your money back. Right now, it's closing in on 4%, and you can look at a bond price by being, a series of, let's say, 3-month, 6-month notes, whatever. What the 2-year yield is showing me, which has gone from under 50 basis points over a year ago to 4%, is absolutely an unprecedented move in interest rates. And, one of the reasons for stock market weakness as well is that, look, you can get you can buy S&P 500 stocks and get the dividend, which is usually somewhere around 3%, or you can buy something that is basically a risk-free asset, a 2-year note, and get 4% right now. And I think the most important thing, which has scared a lot of investors in the last week, is how quickly these yields have risen. I think that these yields are about to peak. Like, I don't think the 2-year yield is going 4 or 5%. I think you're going to see it start to come down, especially later in this week when you start to see that PMI data come in weaker and show signs of a recession. Because, if the economy, which most people think is a recession now, shows more a lack of growth in the future, those yields will come down and that will be good for stock market. So right now, when I see that 2-year yield chart, that is just max pain for stock investors. Like, it can't get any worse than, I mean, it could always get worse, but I'm saying 50 basis points, right? So if you're a stock investor, it used to be Tina, like there is no alternatives. You buy stocks, the S&P 500, you get the 3% dividend, 10-year note was trading at 2.5% or below. 2-year note was, historically around 3% and dropped during the coronavirus to about 50 basis points and under. Now there's an alternative to stocks, right? But the market is also prices in the sense that you can either buy stocks or you can buy something risk-free like a 2-year note yield. If that yield starts coming in again and it reverses this steep up move it has had, that is going to give, send more flows towards the stock market, like we haven't seen this year, right? We've seen a lot of flows come out of bonds into cash, a lot of flows come out of stocks into cash, but you might see flows going from bonds to stocks now if yields pull back, because when you see a sharp move like that, that's usually like, all right, this is it, it's over, time for a reverse. Just like if you saw it go down, you will see the reverse as well.
Okay, well, that's actually a good segue to our next part of our program today, and it's about questions. We got a couple of questions in this week, Ian, from watchers and subscribers of Winning Investor Daily, and I thought I'd let you answer them because they really are pertinent. The first one is from John, and John is writing us from Belgium. Hello, John.
Hey, John.
John writes, I'm a member for years, but I'm wondering what is the cause of the volatility in stock prices as well as cryptos? I see that the news plays the biggest role in the market, but my problem is, why do people so really panic by the smallest negative news and then euphoric by as little better news? I cannot imagine that the world today is doomed and the other day it's heaven on earth. I mean, today one is pessimistic, things happen, and then the next day, that same person will be optimistic. Things happen. And I by myself think it cannot all be so bad. And the other day, it's all changed. Why can people be so influenced by these panics? Prices go up, prices go down the next day, and when nothing's wrong and prices for stocks go up. So what in 1 week we have suddenly bad, then good, and then changing every day. Can you please offer some insights on this phenomenon?
That's a great insight, John. Thanks for writing in. I would say the first thing is that in a bear market, there's volatility on both the up and downside, right? So everybody thinks like, oh, it's a bear market, stocks to go down. But the reality is, if you look at like the top 10 days in the S&P 500, top 10 up days, like the overwhelming majority of them are in the middle of bear markets. And the reason for that is, people lean too far into the fact that the market is going to go down, and then, they get squeezed. I mean, case in point, you had a rally in the NASDAQ from the June lows, I think, to mid-August. That was like, if you had that rally over an entire year in a normal year, you'd be happy about it. It happened like a month. It was like a 15% rally in the NASDAQ, right? Actually, I think NASDAQ in the S&P 500, NASDAQ actually rallied, I believe, 20% off the lows, which like historically, that's a great year. You did that in a month here. And so I understand John's sentiment about why the market is so back and forth. It's when there's a bear market, there's a lot of uncertainty. People are not certain about how the path of interest rates over the next 6 months. They're not certain about the economy, and really all these unknowns lead to less market participants wanting to make a big wager on either side. And from an investor's perspective, that dries up liquidity. When you have less liquidity, you have more volatility. The other thing I would say is why do people panic so much? Well, there's a famous behavioral economist named Daniel Kahneman who wrote about this idea of prospect theory. Are you familiar with prospect theory, Amber?
Not totally, no. So
okay, so here, how about the question is like, if you were given a choice, right? to have $100 and lose $50, right? So you wind up with $50. Or if I just straight up give you $50, which one would you choose?
Of course, people would say, just give me the $50.
Right, right. So prospect theory is the idea that even though the outcomes might be the same, your fear of losing is much higher than the emotion you gain by winning.
Right.
And you see that in the markets quite often where it's like, you know, people start losing and then they start panicking. But in my experience, this has always led to the best investment opportunities, you know, when everyone's losing their head because they don't want to lose anymore. We are going through a normal run-of-the-mill bear market. You know, I've been through 4 or 5 of them in my 25-year investing career. This is not like 2008 where, you know, it's systemic and the entire market, you know, the banking system is going to collapse. We don't have that. We have like a financial system that's very well capitalized. We just are dealing with inflation, which the Fed is trying to fight right now to cause us into a recession. I think it's going to be a pretty mild recession. And when investors start to see that the Fed's job is done, you know, you're going to see a 1 week where the market goes up 5 or 10%, and then the next week goes up another 5 or 10%, and then people start chasing stocks again. I mean, we've seen this pattern over and over again when we've had these big pullbacks in tech stocks. Is that, you know, people have the fear of losing 1 week, but then they have the fear of missing out the week prior, you know, further that. So I think this could be a very consequential week, essentially, with the Fed on Wednesday and Powell perhaps saying that, you know, they front loaded the interest rate increases and then we're just going to sit back and see how things happen. And that'll start to bring down rate hike expectations in the future. And that'll be really good for the stock market. You'll see that 2-year yield come back down as well.
Okay, wonderful answer for Jean. Thank you, Jean, for writing in.
Yeah, thanks for writing in, John.
Okay, we have one other question that's coming from Susan Ian, and it's a crypto question. Susan asks, are you still big on Matic? Thanks all.
That's a great question. Amber, are you a gamer?
No, Ian, I'm not.
Oh, okay.
So don't ask me.
I'm not either, but, you know, I do respect that the video game market is a $200 billion market, right? And
of course,
I have the sense that most of these games are going to be blockchain based at some point in the future. And the reason for that is, you know, the kids these days, not my generation, they spend a lot of time, you know, and attention building out their video games, playing the video games.
Of course.
And, you know, when they're done with the video game, like that whole investment is sort of moot. But what blockchain lets you do is take that investment in one game and transport it to another, right? So you actually have ownership of these digital items that you're investing your time and money in. You know, there's some parents who, like, the kids get the credit cards and the kids spend thousands of dollars on these, like, you know, games building their avatars and whatnot. And the reason why I like Polygon is because in the blockchain space, that is what they are leading in. Polygon is essentially a way to scale Ethereum. So it's known as a layer 2. Ethereum is the largest layer 1. Polygon is a side chain that lets you do transactions at a faster rate. And then eventually those transactions filter into Ethereum and are, you know, hard coded in the blockchain. Some alpha here that I have on Polygon, and this is public knowledge, is that about 10 months ago, what are we in? Yeah. So earlier this year, they hired the head of gaming from YouTube. And they also have somebody on their executive board who spent 20 years as director of community electronic arts, which is a massive video game company. And, you know, Polygon has 19,000 what are called decentralized applications built on top of it already, which is massive. It's the largest layer 2 in the space. And they have a real world partnership with Starbucks. They've got a partnership with Disney. And so they're working for other Fortune 500 brands to bring NFTs into the mainstream. The other thing is they raised, I think, $350 million earlier this year, led by Sequoia, which is like a legend in the VC industry. And so they've got basically a war chest to ensure that NFTs, which are unique things of digital value, become mainstream and can be used, you know, as subscription services or to show your loyalty for a specific brand. Nike is also working with Polygon. That's another one.
Okay.
And they are just uniquely positioned that even though we might be going through a bear market in crypto,
Right.
this is going to be one of those cryptocurrencies that in the next wave, next bull market in crypto outperforms everything else. And we've seen this in the past where in the bear markets, if you just invest in the cryptos that you know are going to be the leaders in the next one, you see absolutely astronomical returns, when the market eventually heads higher in crypto, which, for all intents and purposes, crypto might be dead in the mainstream press, but we know from experience that this is the time to get in now, when everyone's writing the obituary.
Oh.
So thanks for that question.
Thank you, Susan. Great answer there, Ian. I appreciate it. So, Ian, just on another note, turning to Megatrend news, because we always are watching our Megatrends, I'd like to circle back to what we were discussing at the top of the video with Ahmad's question. So according to a press release from Salesforce, which is quite interesting, they released this last week, Salesforce actually just introduced a new and powerful automation and intelligence technologies product lineup for their clients to actually start to implement. And here's what Salesforce found. They found that 91% of organizations say they need automation technology, but only 23% actually implemented it across their business functions. So as customers, their expectations continue to rise, the actual need for more automated, intelligent processes has increased. And where warehouse fulfillment is concerned, Ian, more than 80% of warehouses today lack any type of automation. And this is just showing us that robots and artificial intelligence have a lot of room to greatly grow and change how warehouses work today, and that it's really a mega trend to watch. So that's what I like to cover in the mega trend news. And I just a plug for our Winning Investor Daily just the entire subscription. I have an article that will be emailed tomorrow to all subscribers to our Winning Investor Daily list, September 20th, and I'll actually share further insights on companies today that are now using automation, robotics, and AI to stay ahead of the curve in this type of current recessionary type environment while aiming to make money. So it's just something to keep top of mind, Ian, and I like to share it with everyone in the article for tomorrow. So that's what I have to cover.
Awesome. I'm looking forward to that. Hey, and also, the thing with automation is like it becomes sort of like a war, right? Like, if you're a company that operates warehouses and your competitor starts running their warehouse more efficiently, and thereby their operating margins go up, you're going to start thinking about making those investments yourself. So it becomes kind of like an arms race in automation. And I think that, that is definitely a mega trend that we're going to see just continuing to grow this decade, especially, with the rise specifically of e-commerce, where it's like nobody really goes to the store. You just order things online.
I did that this weekend, Ian, for my mom. I was ordering some groceries and I did it through Instacart, was who I used this past weekend. But there's so many other companies that are even becoming more competitors to that type of environment, that type of business environment. So it's quite interesting to see how this works out.
Yeah, we have like a daily Amazon Prime delivery in our house
every day. Ding dong.
It's not me.
It's not you. I understand. I know. I can feel what you're going through. So Ian, that's what I have to cover for today. Do you have anything else you'd like to explain or share with viewers?
We covered pretty much everything, like what the economic data this week. We got a crypto question that we handled. One other thing I would like to say is, just quick update on the merge.
Yes.
It went through. Ethereum is now a proof of stake chain. And everyone says, oh, it dropped 15 or 20% after the merge. Well, it's, another one of these cases where people were buying ahead of it, thinking that everything was going to change on day one. We still have some more upgrades down the line, which are going to increase scaling because the speed is the same as it was. But the key thing here is that the network is now burning as many Ethereum tokens as it's distributing on a daily basis. And that creates a version of sound money, the likes of, we haven't really seen digital sound money, which could actually be burnt faster than it's sent out. Imagine if the US government decided that instead of printing dollars, they were going to burn more of them. So you pay your taxes and they decide to burn it. Think of how, that would do for the value of the dollar if there was a scarcity of it. That's something that you're seeing happening in Ethereum. It might not happen overnight, it might not happen over weeks, but if you invest in this asset class, especially something that is sound in the sense that it's the scarcity is increasing, they're burning more than they're actually distributing, you will see prices go up over time. And that's why I'm confident, that wherever Ethereum bottoms in this bear cycle, it will be a generational low and opportunity for you to buy into. And just like, any great technologies, if you look at like Amazon early on, it had years when it was down 50 or 70%. The next year would be up 2 to 3x. Then a year later, it would be down 40 or 50%, right? You just have to think about where this technology is going to be 5-10 years from now and have a position size that you're comfortable holding, through hell and high water. If you're not comfortable holding through hell and high water, then reduce the size of your position into something that, you're comfortable with. So that would be my advice.
Excellent advice there, Ian. And as Ian always says, and I agree, fortunes can be made in bear markets just like this, in select positions that Ian recommends, obviously, for this type of, for the future, looking out 3, 5, 10 years from now. Those technologies exist today, and that's where we should be invested now at these discounted prices. So,
absolutely.
Yes. So thank you, Ian, for all your wonderful insights as always. And thank you to everyone for watching. And just know that you can follow Ian and me on Twitter. Ian is at Invest with Ian, and I am at A Lancaster Guru. And please remember to please give us a thumbs up if you do find the content of these videos helpful, as it does support our channel and presence on YouTube. And please click that subscribe button and notification bell to be alerted when new videos are posted. So with that, Ian, I'll just say goodbye. Alex wanted to definitely be on today. He jumped in his chair as soon as we started recording. So yeah.
Slept through the whole thing.
The whole thing he slept, but he's here. So Ian, good to see you. I wish you
You too, Amber.
Okay.
Thanks everyone for tuning in, and we'll talk to you next week.
Talk next week. Bye-bye.